This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Okay, we have a further issue. So I'm still on chapter 8. And we've just looked at the concept and the problems associated with accounting for the provision for unrealized profit, or the PUP, on the closing inventory of the intra-group traded goods. But of course it's possible that there could be a trade in terms of the parent selling to the subsidiary, or the subsidiary selling to the parent, some tangible non-current assets, not just therefore goods for resale, but for some TNCA. It could, for instance, have the parent, the subsidiary, they've got an asset which is, say, got a carrying value of 100 and it's transferred to the subsidiary for 120. There are notes on this in chapter 8, where at the top of the page it talks about the transfer of non-current assets. There's only 4 bullet points and then a quick summary of the method. But this is what we're looking at. This is a problem that we're looking at. These are figures I'm just making up from the top of my head. If we had a carrying value in the parent of 100 and the subsidiary buys that asset from the parent, or is made to buy that asset from the parent for 120, the subsidiary is now going to be depreciating this over its remaining estimated useful life, and they're therefore going to be depreciating 120, whereas if the parent hadn't transferred it, they would be depreciating just 100. So you can see that there's an unrealized profit here on the transfer, but then there's a further adjustment to make, and that's because the subsidiary will be depreciating a larger figure, a larger amount than would have been the case if the asset had remained with the parent. And of course it works the other way around, doesn't it? It doesn't matter whether it's parent to subsidiary or subsidiary to parent. There is still the unrealized profit and still the excess depreciation. Well, let me show you our method, and then I'll probably correct it. In fact, I know I will correct it. So it's up to you whether you write this method down, or I think I probably would do, just to see what's happening, so that you can understand more fully what is happening. We've got the parent and the subsidiary, and we'll say the parent. Now these figures are being made up. They're not in the course notes at all. These figures are being made up. We'll say that the parent bought an asset. It cost them, say, 500 a number of years ago, and they're depreciating at the rate of 10% per annum, and we'll say it's for 3 years. So that's 150 that the parent has depreciated by way of accumulated depreciation. It has a carrying value of 350. This asset is then sold to the subsidiary, and we'll sell it for, well, I don't know what figure do you want, we'll sell it for 380. So we're making and recognizing the parent, we're recognizing a profit of 30. But of course, so far as the group is concerned, that profit is an unrealized profit. Okay, the subsidiary now depreciates it, and depreciates it, it's been depreciated for 3 years. It did have a 10-year life, so I've got 7 years left. Shall I make these figures more easy? I will. I'll make it 385. So I've got 7 years left, and 7 years there, depreciation by the subsidiary is 50, what is it? 55, isn't it? So the subsidiary is depreciating by 55, and at the end of the year this asset has got a carrying value in the subsidiary of 330. But you know, if the parent hadn't sold the asset, if the parent had kept the asset, then the depreciation would only have been 50, and that would mean that the asset was only in the group at a value of 300, but it's in the group now at a value of 330, and that's because we have a 35 PUP on the transfer, but we also have an excess depreciation of 5, where the subsidiary is charged 55 and the parent would only have charged 50. So we have a net PUP adjustment, 35 PUP on transfer, 5 excess depreciation. We have a net 35 minus 30, a net 30 PUP. And the accounting treatment for that PUP, the accounting treatment is to debit the retained earnings and credit the TNCA with the net figure of 30 in the records, or in the retained earnings therefore, in the records of the selling company. Now, that's how I used to set it out. I used to set it out this way for many years, and it's only relatively recently, only within the last 3 years or so, that I've looked at this again, and I'm thinking to myself, why do I need to draw this historical picture of the asset? For instance, I don't need to know that the asset originally cost 500. I don't need that. And I don't need to know what was the accumulated depreciation at date of sale, and therefore I don't need to know the carrying value. I don't need to know how much depreciation would have been charged and what the carrying value would have been. I don't need any of that. And equally, I don't need that, I don't need that, I don't need that. Do you know the only thing I need? The only thing I need is this 35 PUP and the remaining useful life of 7. 35 divided by 7 is 5, and that gives me the PUP, the net PUP of 30. I don't need anything other than PUP on transfer and remaining useful life. And I can work out the rest. 30 is the net PUP adjustment, and it's in the selling company. It's in this case, it's in the parent company. So I don't need all that big picture and historical diagrammatic format for the asset which has now been sold within the group. All I need is PUP on transfer, estimated remaining useful life. I need to know which company has made the sale, and that's it. Now we do have another minor problem. I'll tell you what we'll do first. We'll do ASTA. We'll do ASTA and what's it called? ASTA and Linus. It's example 3 in chapter 8. So just have a look at your course notes, and we'll have a look at example 3, ASTA and Linus. Don't bother reading the numbers, let's read the notes at the bottom. During the year ended December 9, Linus sold a piece of plant and equipment to ASTA for 90. The asset originally cost 200, then written down to 80. Both entities depreciate non-current assets on straight line over 5 full year in the year of purchase, none in the year of sale. ASTA is depreciating the cost of the asset over its remaining useful life, and directors of Linus value the NCI on a proportional basis. Okay, working 1, ASTA, Linus, right at the top there, 60%, 40%. Working 2, just let me get rid of that. Working 2 is the Goodwill working. Costs so far as, oh, it's Linus and ASTA. Oh dear, oh dear, Linus and ASTA. Let's get that right, shall we? The cost so far as Linus was concerned was 160. And the value, the fair value of the NCI investment was proportional, so we don't know what that figure is going to be. But we can say the fair value of the ASTA net assets at date of acquisition. The question tells us retained earnings. Shares 120, retained earnings 3275. Oh, that's awkward, isn't it? 395. And we know that the value of the NCI is proportionate, so that's 40% of 395. 40% of 395 is 140? No. 158, I think. Just let me check it. 4, 5 is 29, 36, 38, 1, 3 is 12. Yep. Oh, add them up. 318 compares with 395. Ooh, 77. It's negative goodwill. Alright. I know how to treat negative goodwill. Actually came up in the it came up in the December 2013 exam, negative goodwill. And some students on open tuition, some students said I got goodwill to be negative, and they seemed upset by that, but the examiner actually said it was a bargain purchase. Other students said, oh, I got my goodwill to be positive. And some very strange comments about different treatments of this negative goodwill. Anyway, we'll look at the treatment of negative goodwill in a moment. Let's look at this PUP. What I will do is I'll draw this picture, this asset. It originally cost 200, and it's been written down to 80. It's been written down to 80, and it's transferred now for 90. ACCA is depreciating it over its remaining useful life, so it's got a carrying value now of 45. If it had not been sold, it would have been depreciated by 40. So we've got this excess depreciation giving rise to a 5 overvaluation. That was the cost, that's accumulated depreciation. That was the carrying value at date of sale, that's the transfer value. There's the depreciation including the excess. That was what the depreciation would have been. And that's the picture, but we don't need it. You know, we've got 10 there, and we've got 2 years remaining, so 10 divided by 2 is 5, and that gives me a 5 difference. And that's all I need. I don't need cost, I don't need accumulated depreciation, I don't need carrying value, I don't need to know what the depreciation would have been, I don't need any of that, none of that. I don't need it. Isn't that amazing? All I need is the profit on the disposal and the number of years over which it is being depreciated. 10 divided by 2 is 5. Take the 5 off, gives me a 5, which is the PUP, and it's in Linus. So now we can do working 3. Consolidated retained earnings. And we have Linus and Asta per the question. Retained earnings of 500 and 600. Is it a mid-year acquisition? No, we bought it on the first day of the accounting period. We have a PUP, it's in Linus, of 5. We have a negative goodwill. What was that? Was that 77 from memory? Yep, 77. That's going to add. That's an added in to the retained earnings. It's like a profit that Linus has made when they acquired Asta. Nothing else, I don't think. So that's 572, 600. If I take away the pre-AC, and the pre-AC profit, that was 275. Good heavens, Asta has done well this year. It was 275. 1 year later, it's 600. That's amazing. So take away the pre-AC, gives me 325, 572. Our share, that's therefore post-AC. And our share was 60%. 60% of 325 is 195. Just let me check it. I don't think it is. It is 210, 6, 5, 30, 6, 2, 12, 13, 14, 15. Ooh! 6, 3, 18 was 195. Is that what I think that's what I said, wasn't it? 195. 767. Is there any goodwill impairment? No, it can't be because it's negative, so that's on the consolidated statement of financial position. Working for A is the NCI, they're 40%. Don't forget, always put that percentage in. The value at date of acquisition. Value at date of acquisition. That's in working 2, isn't it? 158. A share of post-ac. They've done well, haven't they? 40% of 325. Well, it's up there. It's in working 3. There. 40% of 1300. 130. I think so. 288. Less their share of any goodwill impairment. Well, there's no goodwill impairment. It's a bargain purchase anyway. So 288. That's also on the consolidated statement of financial position. So, normally we'd think about putting Inca up there, working 2, but of course it was negative, so it's not there. It gets entirely written into the consolidated retained earnings. T&CA, now here we have a little bit of an adjustment to make. We have 400 plus 240 minus the 10 plus the 5. The 10 was the PUP, but the 5 is the excess depreciation, so the PUP net is just 5. Think about it. That 5 has been deducted. It's been deducted by ASTA. If that had not been transferred, then ASTA would not have deducted that additional 5. So ASTA is charging depreciation on the profit which has been recognised by Linus. So that's 640, 630, 635. Investment in ASTA disappears. Current assets is 440 plus 510, that's 950, gives me 1585. And then we've got share capital, always only ever the parent. Retained earnings, that's in working 3, and that's 767. NCI is in working 4A, and that was, I can't remember that, 288. How we're doing 10, 12, 13, 55, and then current liabilities 230. 230 gives me 50. Oh, good, 1585, and that's excuse me. That's how that works. So let me go back up here. Let's go back to the working 1 normal, working 2 again normal. It's proportionate NCI. It's not likely to be proportionate in the exam. It's more likely to be a share for share exchange and full fair value, but this is a proportionate one. Negative goodwill. Negative goodwill, some strange concepts of what you're meant to do with negative goodwill, but what I've done with it is correct. The end of the first year, the earliest opportunity, that negative goodwill will get added into the consolidated retained earnings. Then we've got all this picture. We have all the picture of the asset and the whole life, the day. And do you remember when you were a child and you had that composition to do at school, a day in the life of a penny? And you had to pretend that you were a penny and write composition. Well, this is what this is. This is the day in the life of an asset. But we don't need it. We just do not need any of that. All we need is the PUP on the transfer and the remaining estimated useful life. And the adjustment is in the selling company. And that's what we have here with the consolidated retained earnings. Per the question, always the top line per the question. Then do the PUP. Account for the negative goodwill. And notice, normally what we have with goodwill in the consolidated earnings, we're normally deducting the impairment. But this time it's a bargain purchase, and so we're going to add it. It's a profit. It's effectively a profit made on the acquisition of the subsidiary. And the correct treatment is to deal with it at the earliest opportunity by crediting it into retained earnings. And then it's just normal. Per the question, take away the pre-act, that gives you the post-act, apply our percentage, and that gives us 195. Working 4, no change, that's just a normal working, and then the balance sheet stroke, statement of financial position. Now what I'm going to do is I'm going to add one further complication. Just let me remind myself what figures I used up here. Here. What did I say? 500, didn't I? This is a way, this is beyond the notes again. I'm making these figures up, so Don't start asking questions and saying, where are these figures in the notes? I can't see them. They're not in the notes. This is a made-up example. It's just coming off the top of my head now. We'll have a similar situation. We'll have the cost of the asset was 500, and we'll depreciate it for 3 years at 10%. So that's 150. So it's got a carrying value of 350. Now, I did transfer that at 385. What I'm going to do is I'm going to transfer it at 400. It's a bit unusual, a bit extreme, because what I'm about to do now is that's got an estimated remaining life of 7 years, because it did have a 10-year life when we bought it, and we depreciated it for 3 years, so it now has presumably a remaining useful life of 7 years. But now a question may say its estimated remaining useful life was reassessed, and it now only has a 5-year life. It's a revision of an accounting estimate, remaining 5 years useful life. And though it re-estimated its remaining useful life, that's what I say. It's a bit strange, because it's only got 5 years left, and yet we're selling it at a profit. You wouldn't have thought that would be, well, I suppose it could be. Anyway, okay, 5 years remaining useful life. So the subsidiary's got this 400 asset, and it's going to depreciate it by 80, which is 400 divided by 5. So now it has a carrying value of 320. The question is, what figure are we going to put there? Are we going to continue to put 50, 50, 50? No, we're not. How can we? It has a remaining useful life of 5 years. So the figure I'm going to put here is 350 divided by 5, which is 70. And that brings it down to 280. So I now have an excess depreciation of 10, and I have a profit on the transfer of 50. I've got a net adjustment of 40, which is represented by that difference. But I don't need 500. I don't need 150. I don't need the carrying value before. I don't need to know what the depreciation would have been. I don't need any of that. I don't need 320. I don't need 80. I don't need 400. In fact, to be honest, I don't really need the 10, do I? All I need is 50. Remaining useful life of 5 years, that gives me the 10. Take the 10 off the 50, gives me 40. And that's the PUP. That's years and years and years. Years and years before most of you were born. I've been setting out the original cost and 15 years depreciation at 32% reducing balance, and oh dear, what a waste of time. How much of my time have I wasted setting out that life story of the picture of an asset which is now being transferred within the group? All you need is the profit on the transfer and the remaining estimated useful life. That's all you need. Of course, as a default, you can always go back and draw the picture, the cost less the accumulated. There's the carrying value, it's the transfer, that's the depreciation. That's what the depreciation would have been. Compare those two, that gives you the net figure. Yeah, you can do that. So long as you understand it, you can always go back onto it. You can always use it as a default program. But if you're quick, if you want to speed up, if you want to score 100% in this exam, the quick and easy way is, you know that figure, you know how many years remaining life it has, take 10, 50 divided by 5 off, gives you 40, net adjustment, and it's reduce retained earnings, reduce TNCA in the selling company. Okay,